Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of corporate finance with a little bit of a knowing smirk. Today we are diving into Ollie's Bargain Outlet's latest quarterly report. Think of it as peeking behind the curtain of a discount retail giant to see if the deals they're offering in stores match the deals they're making for shareholders. Ollie's Bargain Outlet is sharing its financial story for the period ending August 2nd, 2025. It's a chance to see how this good stuff cheap retailer is performing, not just in sales, but in the less flashy but super important areas like costs and profits. We'll also see if their strategy of snagging closeout deals is paying off for investors. Let's jump right into the numbers. This first table shows us the income statement. It's essentially the company's report card on how much money they made and how much it cost them to make it. First glance, net sales, which is the total money from selling their goods, jumped pretty nicely. For the quarter, net sales were almost $680 million. That's a big increase compared to about $578 million in the same period last year. So more people are coming into Ollie's and buying stuff. That's a great start. Now, what's really interesting is gross profit. That's what's left after they pay for the actual products they sell. This figure was around $271 million, up from about $290 million last year. That's a healthy jump, and it means they're keeping more of that sales money. Even better, their gross margin percentage went up too. It's now at 39.9% compared to 37.9% last year. What does that mean in plain English? They're getting better deals on their merchandise or managing their costs more efficiently when they buy. Think of it like finding an even deeper discount when you're buying in bulk. It allows them to hold on to more of the profit. But of course, running all those stores and a business takes more than just buying stuff cheap. We have selling, general, and administrative expenses, or SG&A. This is the cost of running the show, paying employees, marketing, keeping the lights on. This went up to over $175 million from about $45 million last year. As a percentage of net sales, though, it only went up a little bit from 25.2% to 25.8%. So while the absolute number is higher, it's not growing as fast as their sales. That's usually a good sign, meaning they're managing those overhead costs effectively as they grow. One area that really jumped out was pre-opening expenses. These are the costs associated with opening new stores. They're up to nearly $9 million this quarter from about $4.6 million last year. Why such a big jump? As they mentioned, they opened a lot more new stores this quarter, 29 compared to just 9 last year. And many of those were from acquiring leases from bankrupt companies, which often come with higher dark rent costs before the stores are actually open and earning money. Significant growth usually means these kinds of upfront costs. And then there's income tax expense, which naturally follows the increased profits. It's up to about $20 million from $15.7 million. Their effective tax rate, the actual percentage of profit they pay in taxes, stayed pretty stable around 24.8%. All of this led to a nice increase in net income. It grew to over $61 million from about $49 million last year. That's a solid 25% jump in profit. The company also likes to talk about adjusted EBITDA, which is a way to measure their core operating performance by adding back some non-cash items like stock-based compensation and also excluding things like interest and taxes. This also saw a healthy increase, going up by about 26%. It shows their core business is getting stronger. Now, let's look at what they own and what they owe. This is the balance sheet. It's a snapshot of the company's financial health at a specific point in time. One of the biggest numbers here is inventories. For August 2nd, they had over $637 million in inventory. This is up from about $552 million last year. With all those new stores opening, it makes sense they'd have more stuff on the shelves. It's a key part of their treasure hunt strategy to always have new deals for customers. Another big number is operating lease right-of-use assets. This is what they record on their books for all the stores and buildings they lease. This has grown significantly to over $650 million, up from around $494 million last year. This reflects their aggressive store expansion plans. Overall, their total assets have grown to just under $2.8 billion. That's a significant increase from about $2.37 billion a year ago, showing the expansion is real and substantial. On the flip side, let's look at liabilities. Accounts payable, which is what they owe to their suppliers, is over $165 million, up from about $130 million. This also makes sense with more inventory and more sales. They're buying more from their suppliers. Looking at stockholders' equity, it's also grown to over $1.78 billion. This represents the owner's stake in the company. The increase is driven by their retained earnings, basically the profits they've kept in the business. This next table, the statement of stockholders' equity, shows how the owner's stake changed over time. We see activity like proceeds from stock options being exercised. That's when employees buy company stock at a set price. It brought in over $3 million this quarter. We also see shares repurchased. This is when the company buys back its own stock. In this quarter, they spent about $11.5 million doing that. This could be a good sign if they think their stock is undervalued, or it can boost earnings per share by reducing the number of shares outstanding. Now, let's talk about cash, the lifeblood of any business. This statement of cash flows tells us where the cash is coming from and where it's going. Cash provided by operating activities, which is the cash generated from the normal day-to-day business, was about $109 million for the first half of the year. This is up from about $84 million last year. Again, strong sales are flowing through to real cash. Where is that cash going? Mostly into investing activities. Capital expenditures, which is money spent on things like new stores and equipment, were about $53 million. This is down from about $65 million last year, but remember they opened significantly more stores this year, so they might be getting more efficient with their capital spending per store. They also bought investments totaling over $232 million, while maturing investments brought in about $227 million. They're actively managing their cash by investing it in securities. So in total, they used about $58 million in investing activities. This is a lot less than the $159 million they used in the same period last year, largely because more of their investments matured this year, bringing cash back in. Financing activities used about $25 million. This is mainly due to buying back stock and some outflows related to stock options. Overall, they had a net increase in cash of about $26 million this period. So despite all the spending on growth, they're still bringing in more cash than they're spending. Looking at the notes explains some of the accounting details. For example, they detail how they handle revenue recognition for loyalty programs and gift cards, which is standard retail practice. They also detail their investment securities, classifying them as held to maturity, meaning they intend to hold them until they mature. This suggests a strategy of preserving capital rather than active trading speculation. The lease section highlights their significant use of operating leases for their stores, which is typical for retailers to minimize upfront ownership costs. They've got nearly $665 million in lease obligations coming due, including future payments. The company seems to be on a massive store opening tier. They opened 29 stores in this current quarter compared to only 9 last year. Year to date, they've opened 54 stores versus 13 last year. And importantly, a large number of these 40 out of 54 year to date came from acquiring leases from bankrupt companies. This aggressive expansion is clearly a core part of their strategy to drive growth. Let's revisit the financial performance figures. The growth in Ollie's results is pretty clear. Net sales are up significantly. Gross margins are improving, meaning they're more profitable on each item sold. SG&A, while increasing in absolute dollar terms, is better controlled as a percentage of sales. The adjusted EBITDA figures are also quite strong, showing a healthy increase both for the quarter and year to date. This indicates that their core business operations are performing well and generating solid cash flow to fuel their growth. The company is clearly focused on growth, particularly through opening new stores. The numbers show a significant acceleration in store openings this year, many through acquiring bankrupt retailers' locations. This strategy allows them to expand quickly, but it also comes with increased pre-opening expenses. It's good to see that alongside opening new stores, their existing stores, which are at least 15 months old, are also performing well. Comparable store sales increased 5.0% for the quarter. This means when you compare stores that have been open for a while, they're still seeing increased sales driven by more customer transactions. This suggests their treasure hunt model and value proposition are resonating with shoppers even as they expand. Looking at liquidity, Ollie's is in a decent position. They have over $90 million available on their credit line and a substantial amount of cash and investments on hand. They're funding their growth primarily through their operations and their credit facility. Plans for the year include opening about 85 new stores. While they're managing their capital expenditures well, they do mention potential delays in construction and permitting, which is common when growing this rapidly. They also have a robust share repurchase program, having bought back almost 100,000 shares this past quarter for about $12 million. This shows confidence in their own stock. As of August 2nd, they still had over $304 million authorized for future buybacks. An interesting detail is the increase in medical and casualty claims affecting SG&A. This is a reminder that even with strong sales, unexpected costs can pop up. In terms of internal controls, management has assessed them and found them effective as expected. Finally, some executives have entered into plans for trading company stock, which is a normal part of executive compensation and liquidity management. So what's the big picture? Ollie's Bargain Outlet is clearly in a growth phase, aggressively expanding its store footprint, largely by acquiring distressed retail locations. Financially, this expansion seems to be translating into healthy sales and improved profitability, especially on a per item basis, as their gross margins are expanding. They're managing their overhead reasonably well as a percentage of sales, and their cash flow from operations is strong, providing the resources for this growth. The risks, as they've disclosed, include the usual suspects for a retailer: consumer spending, competition, and supply chain disruptions. However, their unique closeout for less model seems to provide some insulation, as customers are always looking for a deal, especially in tougher economic times. The key question will be whether they can continue to find and manage inventory effectively as they scale, and whether their rapid expansion through acquiring bankrupt leases translates into long-term profitable stores without major hiccups. Overall, Ollie's appears to be navigating a period of rapid expansion successfully, with solid financial results backing up their growth strategy. They're a company that seems to understand the value proposition for both the customer and the shareholder. So what's your take on Ollie's aggressive expansion and those improving margins? Do you think they can keep up this pace? Let me know your thoughts in the comments below. If you found this breakdown helpful, smash that like button, subscribe to Corporate Decoder for more insights, and join our Discord community if you want to chat more about these filings. Thanks for watching, and we'll see you next time.